We just had an incredible week in the S&P 500 as we see nearly green right across the board. In fact, in 2024, we have just recorded the best week. And if you wanted to see a gain higher than what we've just recorded, you would need to go to October 2023. On top of that, a historical moment for the market as well, as the S&P 500 crossed 6,000 for the very first time. So great news for investors. Now in today's episode, we are taking a look at undervalued stocks with long-term massive growth potential. We're going to run through each one as always, looking at their historical information. We're going to touch upon their earnings projections over the next 4 quarters. How has management's forecasting accuracy been over the previous 4? And as always, we'll look at some very important metrics you need to understand. Their dividend safety, we're going to talk about dividend yield theory as well as some undervaluation signals for each one, and look at metrics like the free cash flow, like the ROIC, like their debt levels, very important to understanding the fundamentals of each company. And as always, we're going to run each one through our valuation model, getting to our own intrinsic value, getting to our margin of safety, and understanding what Wall Street see in terms of the growth potential over the next 12 months. We also note, whilst the majority of the more glamorous companies have reported, earnings season still continues into next week. Some very large names that you might want to keep an eye on. For example, we can see on Tuesday before the market open, Home Depot reporting. We also have Cisco after the market close on Wednesday, as well as Disney before the market open on Thursday. On top of that, we do like to look at the Fear and Greed Index, and what we find very interesting, we do talk about this changing very quickly, the market sentiment. Just last week, we were sitting in fear, and now we have gone into greed, post some very large news that has taken place over the last few days. Now, the first one to discuss is Donald Trump being elected as president for the second time. Now, the market seemed to love this. As we just talked about, it had the best week in 2024, and this was a very large catalyst. As we saw, once he was announced, the markets over the following 2 days did increase very rapidly. The other thing to note that happened this week, which is less surprising, was that the Federal Reserve cut their interest rates by 25 basis points. This was something that was widely anticipated by the market, so there wasn't much of a surprise, but good to note that this number is starting to come down, and these cuts are expected to continue into December and 2025. Now, one of the companies that benefited very largely from Trump being elected as president was Tesla. As we can see, this hit a 1 trillion market cap company, and in fact, just over the last week, this is up more than 34%, now trading at its 52-week highs. The other company that we did see have a very good week, although in fact they did report their earnings, which was incredibly strong, was Palantir. Not only did they increase their full year guidance for their revenue, but their earnings per share as well as their EPS was very, very strong. In fact, as we can see here, 10 versus 9, as well as revenue coming on top by 25 million. That was also reflected in their share price, as we can see over the last 5 days, up 42%, similar to Tesla, now trading at their 52-week high. In fact, for Palantir, this is an all-time high. Now let's jump into the stocks that we are looking today, all undervalued with upside. The first one is Johnson & Johnson, the dividend king. Now, over the last 12 months, they are up, although marginally 3.5%. Over the last 10 years, they're up around 44%. They are trading the S&P 500, something to consider, but right now they are sitting around the mid to low end of the 52-week range. Now, we get a double buy signal from Seeking Alpha and Wall Street with a hold, which is very typical from Quant. In terms of the forward yield, well, it is above 3%, which is where Johnson & Johnson typically sits. We're going to show you the 5-year comparison. And in terms of the forward P, sitting just under 16. For those that want reference, S&P 500 right now sitting around the 25 mark. In terms of their earnings, well, we can see over the next 4 quarters, they only expect one of them to be positive. And in fact, the next quarter they're reporting on, they're anticipating double-digit decrease to the EPS year on year. However, having said that, the previous 4 quarters, they have outperformed management targets substantially over the last 2, and growth is anticipated into 2025, EPS 10.63, lowering the forward P to 14.74. Now, in terms of their dividend safety, they get a 99. That is the highest score obtainable. And we also notice 3.2% yield is well above the 5-year average, and we have an undervaluation signal, which we will get to. They also increased their dividend this April at 4.2%, which is pretty much the minimum we want to see. Remember, 4.2 is around the inflationary average over the last 40 years at 4%. Now, they've got a very safe dividend score, as we mentioned, the highest score obtainable. This essentially means that a dividend cut is unlikely and was reaffirmed just days ago. Now, in terms of the last recession, every one of these stocks, we're going to look at their key metrics from the recession 07-09. They actually increased the dividend. They had above average growth, -6%, with the S&P -12%, and they significantly outperformed the S&P itself, -27%, when the S&P 500 came in -55%. Now, we already mentioned an in-line with inflationary increase this year, but over both the last 5 and the last 20 years, they have been increasing it above. In fact, over the last 20 years, 8% on average year on year. We also mentioned they're a dividend king, which means 50 or more years of consecutive increases. Currently, they have 61, but they've been paying a dividend for the last 108 years without a reduction. Now, in terms of looking at this valuation model, what we notice is when we zoom into over the last 12 months, this company, bear in mind the blue tunnel is their expected intrinsic value, has been trading for the large part below that point, which does give us that sign of severe undervaluation. It sits even lower than the bottom end of the expected fair price. But remember, we don't look at any one of these models in isolation. We will conclude towards the end. In terms of dividend yield theory, this tells us a company is undervalued when the current yield sits above the 5-year average. So we have one signal here, 3.19 above 2.72, and we have another undervaluation signal based on the forward P, 15.5, that sits lower than the 5-year rolling of 16.5. On top of that, Johnson & Johnson right now is lower than the healthcare sector at 16.8. So all of these signals do point to undervaluation for J&J in the current market. Now, for each one of these companies, we will draw your attention to the free cash flow over the earnings, which is susceptible to manipulation by management through accounting. The reason we use 60%, it does give us faith management can increase dividends at a very attractive rate. We do notice over the last 2 years, it has sat above that, but nice to report on a trailing 12-month as well as the next 12 months, expected to come down to around 61%, which is around the 60% maximum point we want to see. Then we get to free cash flow per share, where we want consistent increases over the long term. We get the increase over the long term. We don't get that consistency, something to bear in mind, but nice to report over the next 12 months, free cash flow is anticipated to increase from $7 to $8.19. Then we get to sales growth. Remember, 3 to 7%. The reason why we say 3 or 4 at the bare minimum is just to keep up in line with inflation. Very inconsistent over the longer term. Yes, fairly decent in 2023 and on a trailing 12-month basis, but understand the type of company this is. You aren't expected double-digit increases every year to their top line. Nonetheless, it has increased from around $74 billion in 2014 to $88 on a trailing 12-month basis. On top of that, for these companies, we want shares outstanding to decrease over the longer term. Companies doing share buybacks, effectively this means they're returning excess cash as you're owning a larger portion of the company. Now they've done that, 2.86 in 2014, 2.43 on a trailing 12-month basis, and this shows actually over just the last few quarters they have been aggressively buying shares. Hopefully this is something that will continue, and perhaps management believe right now, as we have alluded to, this company is severely undervalued. We then move on to ROIC, return on invested capital, one of our favorite metrics. 10% or more, give us faith, management are able to effectively allocate their capital, and we can see very consistent year on year, well above 10%. And do remember, some investors will pay a premium just for getting consistency right across the board, something that we have seen with J&J. We then move on to operating margin. Two things we want to see. First one, above the minimum 12% that we get. Second one that we don't get is operating efficiency, with margins increasing over the longer term. But what we do get is very, very consistent margins, which, as we have seen, is pretty much the theme of Johnson & Johnson. That is also reflected in the free cash flow, sitting around the mid to low end of the 20% year on year. We then get to the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. That is what we get every single year. And remember, the numbers that we see below are the number of years it would take the company to pay off all of their debt net of cash on hand. And why we love this metric correlates to dividend safety, balance sheet strength, 0.25 in 23, 0.49 over the next 12 months. So very strong balance sheet. No surprises why the dividend safety score was the best obtainable at 99. Now let's jump into the valuation model for J&J, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $180, we got this as the average of these three models, and when we do our deeper dives on this channel, we do run through every single one, but today we're going to get straight to it, a lot to cover, and at $180 with the current price around $155, we do like to use a MOS. Now we start off with 10%, execute on this if it meets our three golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for J&J, we'll buy at $162, then we keep going till it's near the current trading price, and it's around $1 shy from the 15% margin of safety, so we see 15% MOS with Wall Street indicating 16% upside over the next year. Their price target pretty much in line with our intrinsic value at $180. Now it is a dividend king, so it does give you that security, although do bear in mind that just because a company is a dividend king doesn't mean it will forever pay dividends. We've seen companies in the past, in fact more recently just over the last few years, who have had to cut the dividend, but there is that to consider. It is giving you a 15% MOS, a yield of above 3%, which is higher than the average, and we also notice 16% upside from Wall Street. As always, as we go along these stocks, do give us your thoughts below, whether you are buying, holding, selling, or maybe just on the watch list. We also want to let you know we have released our latest free weekly article where we talk about 2 stocks we are buying in November. And as always, every single Monday morning we release one to your inbox where we talk about what's happened in the market as well as severely undervalued companies that we do believe deserve your attention. So click below, you can sign up and start reading these straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, as well as the upside that Wall Street see over the next 12 months. And you can also grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside out of the whole S&P 500. So click below, sign up, and you can start reading straight away. We then move on to Elevance Health, which is down around 5% over the last 12 months. Over the last 10 years, though, it is up 242%, which has severely outperformed the S&P. Right now, trading towards its 52-week lows with a double buy rating from Seeking Alpha and Wall Street. 4.45, not far off the 4.5. That would make this a strong buy for them. And we notice, again, Quant giving this a hold. Now, on the yield aspect, 1.52% in terms of a forward P sitting around 13. And when we get to their earnings, we can see over the next 4 quarters, 2 of them growth, 2 of them a decrease, and unfortunately they did have a substantial miss in that latest quarter. And out of the last 4, we are getting a 75% track record, 3 beats and 1 miss. Nonetheless, they are expecting December 2025 to be nice growth, indicating the forward P will come down to around 12.06. Then we get to their dividend safety, which is in line with Johnson & Johnson, 99, highest score obtainable, double undervaluation signal, and they also increased their dividend 10% in January this year. When we look at the key metrics from the last recession, well, they didn't pay a dividend, so no comparative data. They had above average growth, remember, -4 versus -12, and they also marginally trailed the S&P, -61. We do quite like that historically they have been increasing these dividends at a very good and attractive double-digit rate, 15% on average over the last 10 years, whilst increasing the dividend for the last 12 years consecutively. So what about this undervaluation signal? Well, when we look over the last 12 months, for the majority, it's been trading towards the lower end of that blue tunnel, but we actually note just over the last 30 to 40 days, this company is severely undervalued after the drop. It does look like, based solely on this model, that the market has massively overreacted. We also look at dividend yield theory, where we are getting that undervaluation signal, 1.54 above the 5-year rolling, and the forward P below the 5-year 13.9, as well as lower than the healthcare overall at 16.8. So what about their free cash flow payout? Well, we do notice that it has been below 60% consistently year on year, 21 in 2023, 22 over the next 12 months. So January right around the corner, we do expect another double-digit increase from ELV. We also notice their free cash flow has pretty much tripled over the last 10 years, and growth, although marginal, is anticipated over the next 12 months. In terms of sales growth, it has started to slow down over the last few years, but nonetheless, we are looking at nearly double-digit growth every single year out of the last 5. And when we do zoom out and look at it from a 10-year period, this company has more than doubled their top line from 2014 to 2023. They've also returned excess cash. They have done some share buybacks, which is good to see. A little bit inconsistent. Nonetheless, they do seem to do this for the majority of the 10 years. And ROIC looking consistent, but also increasing 12% in 2014, 15% in 2023. We then get to the margins. Now, we are a little disappointed as it is below the 12% we want to see as a minimum, but the majority of companies in this industry do have very similar margins, so this is to be expected. Around 6% in 23, 6% on a trailing 12-month basis, and the same to be reflected on the free cash flow, straddling around the 5% majority of the years, hitting that minimum target. We then get to the net debt to EBITDA. This is 0 right across the board, indicating phenomenal balance sheet for ELV. It won't even take them one day to pay off all of their debt net of cash on hand. Now, our intrinsic value, $551, the average of these three, does indicate a nice MOS. At 10%, a buy at $496. At 20%, around $440, and in today's episode, not quite at the 25 percentage point yet. You're looking somewhere between 20 to 25, with Wall Street, as we saw, on the verge of giving this a strong buy. They see a $540 price target with upside of 28%. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for ELV or any others, and do give us your thoughts about these companies as we go along today. We then move on to QSR, Restaurant Brands International, many in fact brands that you would have heard of under this umbrella. We notice it's trading towards the lower end of the 52-week range, pretty much flat over the last 12 months. Over the last 10 years, we can see a bit of a roller coaster. In 2019, they were trading at just under $80. During the COVID drop, trading as low as $30. And just recently, we can see, in fact, hit around the $80 mark. Now, Seeking Alpha give this a strong buy. Wall Street give this a buy, with Quant again 3 in a row giving this a hold. Nice yield as well, just under 3.4%. Forward P around 20.6. Now, in terms of their earnings, they're expecting growth every single quarter out of the next 4. However, they did marginally miss Q3, but previous to that, we do notice beats. 75% track record with growth expected over the next full annual report, lowering their forward P to 18.11. Then we get to their dividend safety, where we actually see a 45 borderline safe, so we'll check that out. We'll look at their undervaluation models as well, and this year they did increase that dividend higher than inflation at 5.5%. Now, what does borderline safe mean? Well, firstly, it was reaffirmed at the back end of 2023, and ultimately there is a moderate risk of a dividend cut over a full economic cycle. Now, in terms of the key metrics, last recession, bear in mind they cut the dividend, but they did have above average growth at -2%. Now, over the last 5 years, on average, they have kept up in line with inflation. However, over the last 10, they have increased it very rapidly, 25% year on year, and they officially have 11 years of consecutively increasing the dividend. Now, when we talk about this valuation based on the forward P, we notice over the last 12 months, it has gone from around the intrinsic value to slightly lower. In fact, we are seeing it now below the lower end. So that is a big sign of undervaluation, which is also supported by the dividend yield, as we can see, marginally higher than the 5-year rolling, and the forward P by quite some distance, 18.8, below the 5-year 21.8. Although we do notice it is above the consumer discretionary sector, which sits at 18. Whether or not it deserves a premium to the overall sector is something to consider. Now, for restaurants, we do want below 50%. We do notice there have been years where it has been above. 2020, that was COVID. 2023, in fact, the more recent year, as well as over the next 12 months. So one sign why this could be, in fact, getting that borderline safe score, but we will come on to the net debt to EBITDA shortly. We then get to the free cash flow, which has looked very inconsistent on a year-on-year basis, and over the last few years has in fact been decreasing, expected to continue over the next 12 months. However, when we do look at their sales growth, it has been very strong. We do notice double-digit for the majority of the last 10 years, 8% in 2023, double-digit on a trailing 12-month, so we are anticipating 2024 to be a good year for Restaurant Brands International. From a numerical standpoint as well, we do notice growth from 2014 to 2023. And then when we get to their shares outstanding, where we do notice issuance of shares from 2014 to 2015, since then, over the longer term, they have been buying back shares, but very, very minimally. So don't expect this. It may not be a priority of management in terms of their capital allocation. In terms of ROIC, well, above 12% for restaurants, not something they have managed in one single year, but we do notice over the last 3 years and on a trailing 12-month basis, they are getting 10%. Then we get to operating margin, where actually not something we want to see. Remember, on this channel, operating efficiency, you could argue operating inefficiency with margins decreasing. This is also reflected on the free cash flow. However, what we would say to both margins, they are well above the minimums we want to see. So we do still believe it is positive, but definitely something we would say to keep an eye on a quarter by quarter basis. Now, probably the main area that is driving that borderline safe score is the fact that the net debt to EBITDA is above the 3.5 we want to see for the industry. However, we do note since the highs of COVID 2020 at 7.57, it has started to come down, and over the next 12 months is expected to continue. So if they can keep that momentum, continuing to lower their debt, then their dividends should be safe, and hopefully we can see those dividend increases from the past. As we said, they have historically increased it at a favorable rate. Now, our intrinsic value at $78, when we do look at the MOS at 10%, a buy around $71, at 15%, pretty much around $1 shy. So you're getting a 15% margin of safety. Wall Street, however, do believe the price over the next 12 months will be higher. They see $83, upside of 22%. And it could be one to consider in your portfolio if you are maybe lacking exposure to this industry, want a nice dividend yield and fairly attractive upside over the next 12 months. We then move on to Disney, where we get a double buy from Seeking Alpha and Wall Street, with Quant giving this a strong buy. We notice it's trading in the mid to lower end of the 52-week range. Remember, they are reporting their earnings this week. In terms of a forward P, sitting pretty much bang on 20, with a forward yield just below 1%. And over the last 12 months, up 17%, although underperformed the S&P. Over the last 10 years, only up 8%. So historically, not been great. Do remember, though, that past performance is an indicator of the future. Now, over the next 4 quarters, 3 of them they're expecting growth. In fact, this quarter they are reporting they're anticipating 35% year on year. So it will be interesting to see if they do manage to hit that. And over the previous 4, some very nice beats, 100% track record, with the EPS estimate 5.15 for September 25, lowering the forward P to 19.22. Then we get to dividend safety with a 70 score. We get undervaluation, which we'll take a closer look at, and a very nice dividend increase of 50% in February 2024. But remember, it wasn't too long ago. They've only just recently kickstarted the dividend. They maintained it during the 07-09 crash. They had above average growth and pretty much a spot on S&P recession return. Now, as we mentioned, they have recently restarted the dividend. That is why we see these numbers on screen. And we do in fact note this should say 1 year of consecutive increase. Will be interesting to see if they increase it at a rapid rate like they did this year. Then in terms of the valuation based on the forward PE over the last 12 months, a little bit inconsistent, but we can see from May 2024, this company looks to be trading at a substantial discount. And when we do take a look at the forward PE, we do notice 19.5, lower than the 5-year rolling of 24.1. So that is a severe undervaluation based on this model. Now, we won't use dividend yield theory for Disney due to the fact they've only just restarted it. But as we can see, they're saying the 5-year average isn't too far off the current 0.91. And we know pretty much trading in line with the sector of communications at 19.5. Now, in terms of the free cash flow payout, right now we see it sitting around 11%. Over the next 12 months, 19%, indicating to us if they want to, they should be able to increase this at a double-digit rate in 2025. Then we get to the free cash flow per share. Now, no surprise here, they have had troubles over the last few years, but what's really good to see, in 2022, there was a good jump into 23, and that is expected to nearly double over the next 12 months. So growth is starting again for Disney. That is good to see as shareholders. And in terms of the sales itself, looking attractive, 7% in 2023, 3% in the trailing 12 months, so it will be good to hear what management say, what their estimations are for the full year of 24 and 25 to get some idea if this company is going to kickstart that growth, as we have historically seen their top line nearly doubled over the last 10 years. Now, in terms of shares outstanding, if we just look at the last few years, we can see very minimal movement. In fact, they haven't bought back any shares since around 2017, 2018. Since then, they have been diluting your position as a shareholder, so it may be nice to see in their investor presentation what they do say about the capital allocation. Then we get to the ROIC. Last few years, very low. We do want to see this kick back up to the highs of 2014, 2018. One positive thing to note though, 2020, 2021, the lows of 2%, it has started to increase, and we see 7% on a trailing 12 month. Then we get to the operating margin and the free cash flow, pretty much showing us both the same thing here, that they have struggled over the more recent period, but it does look like they are kicking back up to the levels they have historically seen. 5% in 2021, the lowest point. Year on year and on a trailing 12 month, we are seeing the increases take shape, and the same to be said, the lows of 1% in 2022, now sitting at 9%. However, very important to understand with their earnings release and their annual report that they can continue this upwards momentum. Then we get to the net debt to EBITDA, where we do see it at 1.99, very low from the highs of 2020's 3.53, and expected to be there or thereabouts over the next 12 months. Good to report though that is below 3, and therefore the dividend, as we saw, does look to be safe, and the balance sheet for now, based on this information, does look to be secure. Now our intrinsic value of $123, how we got this, we ran it through the DCF model. We can show you very quickly. We have the free cash flow year on year. Now average growth at 50%, we've gone for 12% in line with management expectations, and based on the discount rate, we have the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 123, which when we do run it through the MOS today, at 10% a buy at 111, at 20% a buy at $99, which is where we see this company now. So for the Walt Disney Company, 20% margin of safety, 26% upside over the next year based on Wall Street, with their price target $125. We then move on to another dividend king, Stanley Black & Decker, where we just get one buy rating from Seeking Alpha with a hold from Wall Street and Quant, trading towards the lower end of the 52-week range, a forward yield 3.6%, a forward P sitting at 22.12, and over the last year, not the greatest, up 5%, over the last 10 years, down around 4%, as we can see here, all-time highs sitting around $220. Right now, it is trading significantly lower, around the $90 mark. Now, over the next 4 quarters, they are looking very promising, double-digit growth to the EPS anticipated year on year, with some very strong performances over the last 4 quarters, giving them a 100% track record. 5.62 EPS December 2025, forward P sitting around 16.4, so that is expected to come down very quickly. And in terms of their dividend safety, while sitting at 80 with a double undervaluation signal, but an incredibly disappointing dividend growth in July this year at 1.2%. Now, last recession, they increased the dividend. They had around average growth at negative 16.8 and a near S&P return at negative 58. Now, disappointing in 2024, but over both the last 5 years and the last 20 years, they have been increasing these dividends marginally higher than the inflation rate. And we can see not only a dividend king with 56 years of increases, but they've been paying a dividend for the last 147 years without a reduction. Now, in terms of the forward P, we do get undervaluation, but pretty much being here the first time that has shown us some signs of severe undervaluation, as it is at the lower end, or in fact out of that intrinsic value bucket. And when we do get to dividend yield theory, we are seeing massive undervaluation, 3.64 above 2.7, and the forward P at 17.3, lower than the 5-year rolling. We then look at it in comparison to the industrials, which actually does sit higher at 20.7. In terms of the free cash flow payout, below 60% is what we get in 2023, and that's expected to come down a little bit lower over the next 12 months. So we really do hope next summer we do get a higher increase to the dividend, especially above that incredibly low rate that we got this year. In terms of free cash flow, looking fairly inconsistent on a year-on-year basis, although over the next 12 months it is expected to increase. Do understand with these companies, some are in cyclical industries, some just don't have the greatest growth potential, so always factor this in, especially into your margin of safety. And one thing that we have to point out here is when we do look over the last 10 years, 4 of them have been negative, including 2023. And when we zoom out, look at it from a numerical standpoint, we do see they've increased their top line around 40 to 50%, 11 billion to 16 in 2023. Talking about inconsistency, that is shown through those share buybacks. They've bought shares, they've issued shares. Net position, though, over the last 10 years is a very small 10 million shares that have been bought by management. In terms of the ROIC, whilst it has been above the minimum 10% for the large part, over the last 2 years it has decreased. Nice to see it going back up 7% on a trailing 12-month basis. In terms of the operating margin, we do get above 12% again nearly every single year. Last 2 years not looking good, but it has started to revamp up to 7% on a trailing 12-month. Free cash flow year on year pretty much straddling around that 5 percentage point. Finally, the net debt to EBITDA below 3 is what we want. Now we don't get that, in fact incredibly high and increasing from 2020 to 5.69, but good to see on a trailing 12-month coming down significantly and expected to come down again over the next 12 months. Hopefully they can continue bringing this debt position down, which will help with that dividend increase as well as the overall health of the company. And remember, it is a dividend king. Now, in terms of the intrinsic value, we have just below $100 in today's episode, which does give us a 10% MOS. However, Wall Street are actually a lot more bullish. They see $108. They have upside of 20%, and they do believe this one is serious consideration for any portfolio at the moment. For those that want to see it at a 15% MOS, buy at $85, at 20% around 80, and at the 25 percentage point around 75. However, at this point today, 10% MOS with 20% upside. Do give us your thoughts, buy, hold, or sell below. We then move on to Zoetis, where we get a double buy rating from Seeking Out from Wall Street with a hold from Quant, trading bang in the midpoint of the 52-week range, a forward yield at 1%, a forward P just below 30, and over the last 12 months, pretty much not doing much, up around 2%. Over the last 10 years, though, has outperformed the S&P nearly up 300%. Bear in mind, these numbers don't include dividends reinvested, and their all-time highs you'd have to go December 2021 at $243. Now, they expect growth to continue over the next 4 quarters, and out of the previous 4, the last 3 have been beats, 75% track record, with large growth expected to the EPS in December 2025, lowering the forward P to 27.2. Now, in terms of dividend safety, we have a 74 safe, a double undervaluation with a 15% increase in December 23, so we are anticipating another increase over the next few weeks. In terms of the last recession, well, they actually had some very large growth in terms of sales, plus 30%, and historically, this company is phenomenal as a dividend growth investor, 23% increase year on year over the last 10 years, with, as we can see, 10 years, in fact, of consecutive increases. Then when we get to the valuation based on the forward P, over the last 12 months, it has been trading in and out of the fair value. Right now, though, we do see it below the bottom end, giving us that strong undervaluation signal, which is also mirrored in both dividend yield theory with the yield higher than the 0.74 average, as well as the forward P sitting just below 29 with the 5-year at 33.6. But it is significantly higher than healthcare sector. One thing you need to consider, is this company worth a premium? We do believe so given our deep dives, but as always, do your own due diligence. In terms of free cash flow payout, well, below 60% consistently, 43 in 23, 32 on a trailing 12-month basis, and around that the same over the next 12 months. With free cash flow has been increasing very rapidly, in fact around 4 times from 2014 to 2023, and expected to increase rapidly again over the next 12. In terms of sales growth, looking very healthy on a year-on-year basis, 6% in 23, 9% on a trailing 12-month, and when we do zoom out, we can see this company pretty much doubled, just under $5 billion in 2014, 8.6 in 2023. They've also returned excess cash, as we can see through those share buybacks, buying around 10% of those shares outstanding from 2014. In terms of ROIC, looking very good. Now, these are some of the metrics why we do deem companies to trade at a bit of a premium. Not only is it above 10% minimum, but it's increasing from 22% in 2014 to 27% on a trailing 12-month basis. And we get a sign here of operating efficiency, not only above the minimum 12%, but 24% was that margin in 2014, 36% over the last 12 months. And the same to be said for the free cash flows, looking absolutely gorgeous, 25% on a trailing 12 month. Then we get to the net debt to EBITDA. Below 3 is what we get, and decreasing over the longer term. 1.18 anticipated over the next 12 months. So great balance sheet as well as the dividend that does look to be safe. Now our intrinsic value, $234, current price at $175, giving a 10% MOS, a buy rating at $210, at 20% a buy at $187, and at 25% right now where the current market trades for. So 25% MOS, Wall Street very bullish, just under 30% upside with a 225 price target over the next 12 months. Is this one that you are considering to add to the portfolio, or maybe you believe it does trade at a very high valuation and even with this MOS isn't one to consider? We then move on to Archer Daniels Midland Company, ADM, which is down 28% over the last 12 months. Over the last 10 years though, it is pretty much flat, so that hasn't been great for longer term shareholders, and all-time highs around the $100 mark around 2 years ago. Right now, as we can see, trading half that value. Now it is trading at the lower end of the 52-week range with just one buy rating from Seeking Alpha and a double hold from Wall Street and Quant. We see a forward P at around 10.5 and a forward yield at around 3.81%. Now out of the next 4 quarters, only one of them they expect growth, and they've actually missed 2, including the more recent quarter, giving them a 50% track record and a marginal increase expected, very marginal, to the EPS in December 2025, bringing that forward P down to around 10.3. Now dividend does look to be safe, 70 score, a double undervaluation with a very attractive dividend increase at 11% in January this year. Now in terms of looking at the key metrics, well, they increased the dividend, they had below average growth, but they massively outperformed the S&P, negative 21% return. Dividend growth over the last 5 years, around 6%. Over the last 20, double digit. That is very good to see. And we also notice they are nearly a dividend king. In fact, a dividend aristocrat, as they've increased them for 25 years or more. 2 years away from becoming a dividend king. And they've been paying a dividend for 93 years without a reduction. Now, in terms of the forward P, when we zoom in over the last 12 months, pretty much every single day over the last 12, they have been trading at severe undervaluation. And we can also see this being re-emphasized on both dividend yield theory, with a yield in fact 3.84, severely above the 5-year rolling, as well as the forward P 11 above the 5-year of 13.7. We also know well below the consumer staples at 17.8. Now, in terms of the free cash flow payout, below 70% is what we want to see for consumer staples. That is what we get over the last few years. A small increase to 48% over the next 12 months still indicates, though, that this is below the maximum level. And when we get to the free cash flow, we do notice it has been negative from 2016 to 2020. It's picked up since then, but very inconsistently, with a drop expected over the next 12 months. Then we get to the sales growth. We do notice, in fact, 5 of the last 10 years have been negative, including 2023. And when we get to the sales in terms of a numerical format, it has been very up and down, 81 in 2014, 94 in 2023. Now, whilst they have bought back shares, it is very, very inconsistent, so definitely worth taking a look at their capital allocation to see how much they prioritize this in terms of shareholder return. Then we get to the ROIC, above 12% is what we want to see. Not what we get, but nice to see the last 2 years haven't been too far off, sitting at that 11% point. And the margins very, very low, although you could argue this is what we see typically in this sector. Above 16% is what we want, around 4% over the last 2 years. One thing though we would give them credit is very, very consistent. In terms of the free cash flow margin though, over the last few years hasn't looked too great. 4% on a trailing 12 month. Would be nice to see this go up to at least 7% at a very minimal level. Good to report though, their net debt to EBITDA is well below the 4 maximum we want to see, 1.28 in 23, expected to increase to 2.3, still lower than the 4. We do see the dividend, that does look to be safe. Their increases have been very good, so it doesn't look like there are any issues for the time being based on this information. Now our intrinsic value around $65, not far off Wall Street 64, where they see 23% upside. And when we do run it through the MOS, 10% a buy at 58, at 15% a buy at 55, and at 20% pretty much where we see this company now, around the $52 mark. So 23% upside from Wall Street, 20% MOS. Is this a buy, hold or sell? We then move on to Dollar General, which is sitting at its 52-week low. We get a bit of a traffic light system here, seeking alpha with the hold, Wall Street with the buy, quant with the sell. Yield just above that 3% point. Forward P just above 13. Over the last 12 months, hammered down 36%. Over the last 10 years, up only 20%. Now, when we look at their estimations moving forwards, 2 of the next 4 quarters are expected to be growth. They did miss on the more recent quarter. However, the previous 3 we do see beats. 75% track record, nice EPS growth expected over the next full year, lowering that forward P to around 12.3. Now, dividend does sit at borderline safe with a severe double undervaluation score, and we are still waiting on that dividend increase since last year. So in terms of looking at their key metrics, important to understand they cut the dividend in the previous recession, although they did have around plus 4%, which was well above that negative 12 of the S&P. They have also historically increased the dividend at a very good rate, 18% as we see year on year over the last 20 years. And when we get to the valuation model based on their forward P, we do notice pretty much around May, June, this company has been trading below the lower end of the expected fair price by a significant distance at the current point. So definitely one to consider in the portfolio. In terms of dividend yield theory, we can see that massive jump from the 5-year average, as well as the forward P that trades substantially lower than the 5-year rolling of 20.2 and substantially lower than consumer staples at 17.8. What about the free cash flow payout? Well, below 40% is what we want for the industry. 75, so quite high in 2024. Expected to be lower at 59 over the next 12 months. So hopefully we can see at a bare minimum an inflationary increase to the dividend. Now, free cash flow per share was increasing very nicely from 2015 to 21-22. However, it did drop, but one thing we can see is 2024 is expected to see an increase into 2025. So hopefully this does come to fruition. And their sales growth doesn't look bad at all. Remember, 3 to 7% is what we want to see at the lower end, but we do notice 2024 was one of their worst years, just below inflation at 2%. But when we do ultimately zoom out, this company has more than doubled their top line from 2015 to 2024. On top of that, they have been buying a significant amount of shares. In fact, nearly 1/3 of what was outstanding in 2015, which is a nice thing for the shareholder to note. And in terms of ROIC, one worrying factor is that it has started to decrease over the longer term, 9% in 2024. So definitely something to keep an eye out, especially when they report their next full year annual accounts. In terms of margins, plus 10% for consumer retailers, again, has been decreasing, so we can understand why this company has taken a hit to their share price. Important thing to take a look at is whether or not you believe the market has overreacted with this. And the free cash flow, whilst it has dropped to the lows of 2023, based on 24 and the trailing 12 month, it does look like it is starting to pick up. Then we get to the net debt to EBITDA. Below 3 is what we want. Now, we noticed it has been increasing from the lows of 2021, 3.33 over the next 12 months. So definitely lots to consider with this company. Maybe you believe the metrics aren't good enough, or maybe you just want a nice margin of safety. Now, our intrinsic value at $98, not far off Wall Street, 102, basically 32% upside over the next year. And when we put it through our calculations, at 10%, a buy at $89, at 20% around 78, 67, which is pretty much around the current price. 20% MOS, 32% upside for those that want to see at 25% around 74 and at 30% around $69. Today's episode though, 20% MOS with 32% upside. We then move on to Pfizer, where we have a double buyer rating and the hold from quant, trading at the lower end of the 52-week range, a yield above 6% at 6.12, a forward P of 9.4. It is down around 13% over the last year. Over the last 10 years, down around 11, as we can see the peaks of COVID during that $60 price. And then we get to their earnings. We're expecting, in fact, 3 of the next 4 quarters to be a decrease with a large increase in Q4. But this is a company that by quite some distance does tend over the last 4 quarters to outperform, 100% track record. But we do have to let you know, over the next full year, they are expecting a small drop to the EPS, which will therefore increase the forward P, although fairly marginally. Now, nice to see for a company that yields above 6%, a 75 safe score, but one thing that is disappointing was last December the increase at 2.4%, but that does highlight the fact that we are anticipating an increase over the next few weeks. In terms of key metrics, well, they cut the dividend during the last recession above average growth, but they also marginally outperformed the S&P negative 45%. We do, however, note over both the last 5 years and the last 20 years, they have been at a bare minimum increasing the dividend in line with inflation, with 13 years of consecutively increasing it. In terms of the valuation model based on the forward P, over the last 12 months, it has been trading up and down. Right now, though, we sit at the lower end, indicating possible undervaluation. However, when we do look at both the yield, which is above the 5-year, as well as the forward P below the 5-year rolling, we do get more undervaluation signals, and a final signal here with the healthcare sector as a whole being significantly higher at 16.8. In terms of the free cash flow payout, well, below 60% is what we typically get on a year-on-year basis. However, in 2023, triple digits, referencing the fact that they paid out more in dividends than they generated in free cash flow, although expected to drop over the next 12 months. So hopefully, at the bare minimum, we see a 4% inflationary increase. Now, no surprise, a lot of these metrics will show us the same thing. Pretty flat up until COVID, where they had some great years. Then it dropped significantly, but what we are noticing over the next 12 months, it is expected to pick up and quite substantially. In terms of sales growth, again, what we just mentioned here, up to COVID, not too much happening in terms of their top line movement. Then COVID saw some very large growth, and post-COVID, a very large drop. So from a numerical standpoint, we can in fact see 2014 to 2020, in fact, a little bit of a decrease. Then it essentially doubled, and over just the last year, we do notice a nearly drop of 50%. In terms of share buybacks, this is something we have noted from 2014 to the trailing 12 month, but again, very inconsistent. Definitely something to analyze in terms of management and their expectations. From our more recent review, this isn't something they have a plan for in 2024 and 2025 for the time being. ROIC looking fairly inconsistent, a drop into 2023. Nice to see growth over the trailing 12 month. Hopefully something we can see, as we mentioned, above the 10% point. Operating margin, very inconsistent. For the large part, yes, above 12%, but over the last year, in fact, we see it drop to 9%. Good to see, picking back up to 19% on a trailing 12 month. And the same to be said for the free cash flow. Very good. It has dropped in the more recent year, but nice to see picking back up on the trailing 12 month. Then we get to the final metric, the net debt to EBITDA. Below 3 for the majority of the years, unfortunately not for the more recent of 23 at 3.75. Although we can see dropped on the trailing 12 month and over the next 12 months, which is a good sign. Management do seem to be taking care of things. And actually from what we have seen, they are looking to pay off a significant amount of debt and lots of cost reductions. So in terms of the valuation for Pfizer, our intrinsic value, $37, does give a nice MOS. In fact, in today's episode, we are looking not at the 30% level point just yet, sitting somewhere between the 25 to 30% point. So let's say 25% up to $28. Wall Street themselves, 24% upside, price target $33. And remember, you are getting a yield above the 6 percentage point. So give us your thoughts below, buy, hold, or sell. And if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking below, joining us in the Patreon as well, where we do discuss our weekly buys and sells. And as we said, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Pfizer, or any that you do desire. As always, have a great day, and we'll see you all on the next one.